Cash is sitting in your account right now. Feels safe, feels responsible. But what if holding cash is the exact move keeping you stuck? What if the wealthy already know something you don't, and they're quietly using it against you? Today, we're covering 10 assets the wealthy buy instead of holding cash. Not theory, not hype. Actionable intelligence for people rebuilding wealth after 40. Stay until the end. The final insight changes everything. Here's what nobody tells you. The financial advice you've been given was never designed for you. It was designed for the people giving it. Think about that for a moment. Every article, every app, every well-meaning advisor pushing you to stay fully invested, they all profit when your money is in their system. Not yours, theirs. And while you followed the rules, something quietly went wrong. You did everything right. You invested consistently. You kept a small emergency fund. You avoided wasting money on cash. But markets dropped. Emergencies hit. Opportunities appeared and disappeared while you stood frozen. It's not a character flaw. It's not a failure of discipline. It's a design flaw in advice that was never built for your situation. $1 saved in 2010 buys significantly less today. That's not an opinion. That's arithmetic. The question isn't whether you should stop holding cash entirely. The question is, what should you be building instead? This brings us to the core concept of today's video. Call it the wealth deployment system. Here's the one-sentence definition. The wealth deployment system is the deliberate, psychology-informed process of converting idle money into productive assets that generate income, appreciation, or both. There are 3 phases to this system. Phase 1 is called foundation, building your base assets that provide income and stability. Phase 2 is called expansion, layering in assets that grow in value over time. Phase 3 is called leverage, using advanced vehicles that multiply your existing wealth without requiring additional labor. We'll walk through all 3 phases today as we cover each of the 10 assets. By the end, you'll see how they connect. You won't just have a list, you'll have a map. Before we go further, I want to pause here, because if you're watching this video, there's a good chance you felt something specific in the past few years. Maybe you worked hard. Maybe you did everything right, saved, avoided debt, kept a cushion. And yet something still feels off, like you're running in place, like the finish line keeps moving. Drop a number in the comments right now. Just a number. How old were you when you first realized the standard financial advice wasn't designed for people like you? There's no wrong answer. This is just about seeing how many of us are at the same crossroads. Because the struggle isn't a personal failure, it's a systemic design. The financial industry was not built to make you wealthy. It was built to keep your money moving through their ecosystem. That distinction matters. And once you see it, you can't unsee it. Here's what behavioral finance actually tells us about why intelligent people hold too much cash for too long. It comes down to something researchers call loss aversion, the psychological reality that the brain registers potential losses roughly twice as intensely as equivalent gains. This isn't a character flaw. It's neurological wiring. When markets drop, the brain triggers the same alarm systems used for physical threats. It floods the body with stress hormones. It narrows thinking. It pushes toward inaction or retreat. Cash feels safe because it's familiar. It's tangible. It's countable. But that feeling of safety is a cognitive illusion, not a financial reality. There's also something called status quo bias, where the brain defaults to whatever is already in place simply because change feels risky. So even when someone intellectually understands that cash is losing value, the brain resists moving it. This isn't weakness. This is predictable human psychology operating exactly as designed. Understanding this is the first step toward overriding it, not through willpower alone, through a system. Here's someone who illustrates this perfectly. Consider a composite profile. He's 47 years old. former operations manager at a mid-sized manufacturing company. After a restructuring in his mid-40s, he found himself with a severance package, a modest retirement account, and about $90,000 sitting in a savings account. He felt secure. He'd worked hard for that money. He wasn't going to gamble it away, so he waited. He waited for the right moment. He waited for clarity. He waited until the market felt safer. 2 years passed. Inflation had quietly consumed thousands in real purchasing power. Meanwhile, rental properties in his region appreciated significantly. Pre-IPO opportunities came and went. Dividend stocks kept compounding for everyone who owned them. He wasn't reckless. He wasn't uninformed. He was caught in a very human trap, the trap of mistaking stillness for safety. What finally changed things for him was understanding that every month of inaction had a real cost, not a hypothetical one, a real one. Once he reframed inaction as a decision, not the absence of one, everything shifted. Now let's get into the actual assets. These are the 10 vehicles the wealthy are buying instead of letting cash sit idle. Asset number 1 is rental real estate. This is the most well-documented wealth-building vehicle for people rebuilding after 40. Here's why it works at a psychological and financial level. Rental properties generate monthly income. That income creates what researchers call a positive feedback loop in the brain. Consistent, predictable reward signals that reinforce the behavior of investing. Beyond the monthly cash flow, real estate appreciates over time and provides tax advantages that paper assets simply don't. Mortgage interest deductions, depreciation, cost segregation strategies. These aren't loopholes. They're features of the tax code specifically designed around real estate ownership. The key distinction here is this. It's not about owning your home. It's about owning other people's homes while they pay down your mortgage for you. Asset number 2 is dividend-paying stocks, not growth stocks chasing headlines. Dividend payers, companies with long histories of returning cash directly to shareholders on a quarterly basis. This matters for a specific psychological reason. Dividends create income without requiring you to sell anything. You never have to trigger a taxable event just to access the money your investments are generating. For someone rebuilding wealth in their 40s and 50s, this distinction is significant. You're not waiting for some distant future payday. You're building an income stream that grows each year as companies raise their dividends. Asset number 3 is a business interest, not necessarily starting from scratch, though that's one path. A business interest can mean buying into an existing business, acquiring a small local operation, or building a side business that eventually runs without your daily involvement. What distinguishes the wealthy here isn't just owning a business. It's building a business that operates as a system, one that generates revenue whether or not you're physically present. The initial years require significant effort, but the long-term output is an asset that produces cash flow and can be sold, passed on, or scaled. Employees trade time for money once. Business owners build machines that trade value for money repeatedly. Asset number 4 is index funds and ETFs. Before anyone says this is too basic, understand something. The majority of wealthy individuals hold a significant portion of their portfolio in broad market index funds. Not because it's sophisticated, because it works. Over any extended rolling period in modern financial history, diversified index investing has outperformed the vast majority of actively managed funds after fees. The psychological advantage here is automation. Consistent contributions remove the brain's tendency to time markets. It's not flashy. It's not exciting. That's exactly the point. Asset number 5 is commodities. Specifically gold, silver, and energy-linked assets. These are what some call real money. Tangible assets with inherent value independent of any government's decision to print more currency. When inflationary pressure builds, when geopolitical uncertainty rises, commodities tend to hold or increase in value while paper assets fluctuate. For someone in their 40s rebuilding wealth, a meaningful allocation to commodities isn't a hedge against paranoia. It's a rational diversification strategy. It's not a prediction that the world is ending. It's an acknowledgement that currencies lose purchasing power over time and real assets don't. Asset number 6 is online income-producing assets. This is one of the most underappreciated categories in traditional financial conversations. A website that generates advertising or affiliate revenue. A digital course built once that sells continuously. A YouTube channel that creates intellectual property compounding in value over time. These are assets. They require upfront time investment. They often cost very little to start, and once established, they produce income with minimal ongoing labor. The brain often discounts this category because it doesn't feel like investing in the traditional sense. That's a bias worth examining. The wealthy who understand the digital economy are building these alongside their traditional asset portfolios. Asset number 7 is private equity and alternative investments. Here's where the conversation gets more serious. High net worth investors now allocate roughly 30% of their portfolios to private and alternative investments. Private equity, venture capital, private real estate syndications, pre-IPO opportunities. These asset classes have historically outperformed public markets by meaningful margins. The challenge is access. In the United States, most of these vehicles require accredited investor status, a net worth of at least $1 million excluding primary residence, or annual income above $200,000. But here's the critical insight. Even if you're not there yet, building toward this threshold should be a deliberate part of your plan. And platforms now exist that open some of these opportunities to non-accredited investors at lower minimums. The door is opening. Position yourself to walk through it. Asset number 8 is your professional skill set. Treat it as a deployable asset, not just a job qualification. Time is finite, but the income generated per hour of time spent is not fixed. Upgrading skills, pursuing credentials, building expertise that commands premium compensation. These are investments with returns that compound across an entire career. A person who invests 2 years in becoming significantly more valuable in their field may increase their annual income by $30,000 or $40,000. Compounded over 20 years, the return on that investment dwarfs most traditional financial vehicles. The brain tends to categorize skill development as spending, time, money, effort. The wealthy categorize it as capital allocation. That reframe changes everything about how decisions get made. Asset number 9 is your physical health. This will raise some eyebrows in a financial video, but consider the data. Chronic illness in the United States is the single largest destroyer of household wealth outside of divorce. Medical bills, lost income, reduced productivity, diminished cognitive function affecting financial decisions. Investing in physical health through preventive care, consistent exercise, quality nutrition, adequate sleep, is one of the highest return investments available. It's not separate from your wealth strategy. It's central to it. The brain needs a functioning body to make good decisions over a long time horizon. The wealthy understand this. They allocate time and money to health maintenance the same way they allocate to financial assets. And Asset 10, your network. Specifically, a deliberately built, value-generating professional and personal network. The research here is consistent across decades of economic literature. Access to opportunity is not distributed randomly. It flows through relationships. The person who knows about the off-market real estate deal, the person who gets the call about the partnership opportunity before it goes public, the person who gets the referral that doubles their business. These outcomes aren't luck. They're the product of intentional network building over time. Your network is an asset that appreciates, generates yield, and compounds. Take care of it the same way you take care of your financial portfolio. Now, there are 2 key things you should know at this point. First, If something in this video has shifted how you see your own financial situation, drop a specific comment below. What's the one asset you've been overlooking? The conversation in the comments of this channel is genuinely one of the most valuable parts of building alongside people who get it. Second, if you're not subscribed yet, consider this. This channel isn't a playlist of random financial takes. It's a curriculum. Each video builds on the last. Subscribing means following a sequence designed to take you somewhere, not just giving you something to watch while you scroll. That's a different value proposition. Take it seriously. Now here's the insight that rewards the people who've stayed with this video past the halfway point. The real reason the wealthy buy these 10 assets instead of holding cash isn't just about returns. It's about optionality. Cash has a single function. It sits there and waits. Assets have multiple functions simultaneously. A rental property generates monthly income and appreciates and provides tax benefits and can be refinanced to extract equity and can be passed to heirs with favorable tax treatment. A dividend stock generates income and appreciates and can be used as collateral for a loan without triggering a sale and grows its dividend payout over time. This is called the multiplication principle of assets, a single vehicle generating multiple forms of return simultaneously. Cash generates none of these. What looks like safety is actually the elimination of optionality, and optionality, the ability to choose and act, is the defining feature of real wealth, not the number in the account. The range of moves available to you at any given moment. There's one more layer worth understanding: the buy, borrow, die framework. It's completely legal. It's been used by the ultra-wealthy for decades. The basic logic is this: you buy assets that appreciate. Instead of selling them to access cash, which triggers capital gains taxes, you borrow against them at relatively low interest rates. The borrowed money isn't taxable income because it's a loan, not a sale. Your assets continue appreciating untouched. When your heirs eventually inherit those assets, something called a stepped-up basis effectively eliminates the accumulated capital gains tax liability. This isn't a loophole exploit. It's the tax code working exactly as written. But nobody in the mainstream financial media explains this clearly because the entire industry profits from your money being liquid, invested, and generating fees, not borrowed against and held forever. Understanding this framework changes how you think about every asset on this list. You're not building to sell. You're building to hold, borrow, and pass on. Now I want to tell you about something that belongs directly alongside everything we've discussed today. The Trip to Wealth Command Center brings every part of your financial life into one clear strategic system. It's a Google Sheets-based hub that unifies your income, spending, investing, asset allocation, compounding projections, and net worth tracking in a single place. The goal is simple: reveal money leaks, surface growth opportunities, and show how small, consistent choices turn into meaningful wealth over time. Join the early access list below to lock in a supporter discount. No subscriptions. Every wealth system needs a strategy. This is where yours starts. Here's where we land. At the beginning of this video, you saw cash in your account and felt something. Maybe safety, maybe frustration, maybe both. That feeling makes complete sense given everything the financial world has trained you to believe. But the 10 assets we covered today exist precisely because the wealthy learned something the mainstream never teaches. It's not about having more money to start. It's about deploying what you have into vehicles that work while you're not watching. Rental real estate, dividend stocks, business interests, index funds, commodities, online assets, private equity, skills, health, network. Each one of these moves money from a position of stagnation into a position of momentum. The brain wants security. Real security isn't a number sitting still in a savings account. Real security is a portfolio of assets generating income, appreciating in value, and expanding your options with every passing month. That's the transformation this system is designed to create. Remember, This video is for educational purposes only and does not constitute investment advice. It is important to conduct thorough research and consult with financial professionals before making any investment decisions. Always assess your risk tolerance and investment goals before allocating your capital. If this video helped you see your financial picture differently, I highly recommend watching my next video. Hit the like button. It genuinely signals to the algorithm that this content deserves to reach more people rebuilding exactly where you are. And the next video in this framework goes even deeper into a specific strategy that changes how you approach every financial decision you make going forward. You don't want to miss it. It picks up exactly where this one ends. Until next time, stay consistent, stay patient, and stay winning. See you in the next one, Money Magician.